Want to start your investing journey but want something that is relatively safe and easy to do? Well, exchange traded funds may be the best bet for you, and today I'm going to tell you everything about them. How's it going, guys? Ryan here with another investing video, and today we're talking about ETFs, also known as exchange traded funds. But before we get into that, guys, please remember to like this video as it helps me out so much with the YouTube algorithm, and subscribe to keep up to date with all the latest investing and stock market content. I'd love to know below your thoughts on ETFs for new investors. And with that, guys, let's get straight into the video. So just briefly, what is an ETF and why should you invest in them? Well, effectively an ETF is a managed fund that can be bought and sold on the stock market just like any other stock. And the aim for these ETFs is to generate passive income. Because the ETFs are managed by funds in particular, they are making the decisions for you on what companies to add into the ETF and what companies to remove from the ETF. So you don't have to do anything. And this is great for someone who is not too interested or doesn't have the time to invest in individual companies, because effectively you've got somebody else doing it for you, and it just generates that passive income for you over time. Effectively, there are 7 types of ETFs you're going to invest in. I'm going to explain these for you so you can make the best decision on which is most suited for your investing style. Now, the first type of ETF is the broad market ETF. And effectively, this is an ETF which focuses on index funds. And index funds are things such as the S&P 500, the ASX 200, the Dow Jones. What these ETFs are comprised of is the exact same companies that exist within these different index funds. So if you effectively want to follow the market, these are the best option for you. The second type of ETF is the sector-based ETF, and effectively a managed fund will put together a group of companies within the same sector, and these have focuses such as a technology-based ETF or a healthcare-based ETF, or even something such as an industrial-based ETF. And effectively the benefit here is if an industry is going incredibly well or a sector is going incredibly well, you're going to reap the rewards as you are across a large volume of shares within that area. Now, the other side of that is if a sector is performing poorly and is going down. So as many of you probably would remember, the lithium sector had a huge rise and then a huge decrease after 2017-2018's bull run, then you are going to suffer, and you'll see that the lithium ETF absolutely plummeted. So that's what you want to take into consideration. You may see a lot larger increases in a sector ETF as opposed to the broad market ETF, but the same is for losses, and as a result, your risk profile is increased. The third style of ETF is the dividend ETF, and this is one of the favorites for passive income investors, and it's where the managed fund puts together a set of companies that consistently pay out high yielding dividends every single year. And what this means is that it is relatively safe due to the fact that these companies are quite stable, but that means they're also not growing in the sense of your high growth type stocks. So for instance, the actual capital value that is sitting there within this ETF may not change. You'll see it's relatively stable, but you'll consistently receive those dividend payments. So if you want to increase the value, you're going to have to keep putting more money into these ETFs. It's a lot lower risk, but it is a stable stream of income. The fourth type of ETF is the style-based ETF, and there are 2 key types of style-based ETFs. The first of which is the value style, and the value style is where the managed fund selects companies which they believe are undervalued and are likely to increase in the medium to short term. The second type is the growth-based ETF, and this is where the company puts in high performing growth stocks, so stocks that consistently increase in share price every single year and on a consistent basis. Now what we're seeing here is you're not getting those high dividend payments, but instead your actual asset is increasing in value, or your stock price is increasing in value at a higher rate every single year. So if you want to focus more on the companies where your stocks are increasing in value as opposed to getting paid dividends, that is probably the best option for you. The fifth type of ETF is the commodity-based ETF, and this is for if you want exposure to the commodity market. So for instance, if you think gold is going to significantly increase in value, you can invest in a gold ETF that is comprised of various gold stocks. And this is great for if you have some sort of an understanding of the different sectors that are going to perform well in certain years versus the certain sectors which aren't going to perform very well. Because instead of just investing in everything, like when you invest in a broad market ETF, you can specifically target even more than the sector-based ETF with the commodity-based ETF on that individual commodity. So for instance, if we're talking about something that is hot at the moment, it is lithium. So you might want to invest in the lithium ETF as it is currently increasing at a significant rate. Alternatively, another option may be the rare earth ETF. This has increased in value significantly over the past couple of months due to the demand for battery metals. The sixth type of ETF is for if you want exposure to the foreign currency market, and it is the currency style ETF. And so for instance, if you think the US dollar is going to increase in value, you can invest in an ETF which follows exactly that. This is for more hedging your bets against the market rather than solid investments. So if you're unsure of what's happening within the markets, the currency-based ETF may be the one for you. The seventh and final type of ETF is the bond ETF, and this literally focuses on following different bond markets. So for instance, if you think corporate bonds are going to go up, there are ETFs out there for you. I tend to steer clear of the bond ETFs as you really need to know what is going on in that area at this point in time, and it is a lot riskier. In saying that, the jumps can be quite a lot more significant in value than the other types of ETFs. So you have a risk versus reward scenario that you really need to play up here. And that is all 7 of the different types of ETFs that you can invest in. And as you can see, you can really tailor which ETF you invest in to your investing style. If you want dividend paying shares, then you can invest in the dividend paying ETFs. If you think a certain commodity is going to go up in value, then you can focus on that commodity. The benefit of investing in ETFs is effectively that it diversifies yourself so that you're not literally relying on one company to perform. Another benefit is the fact that it is managed by a fund. So if there is an underperforming company within an ETF, the company that is managing the fund will remove it, and vice versa. If there is a company that is performing really well, they'll add it to the ETF. So guys, please remember to like this video, it helps me out so much, and subscribe for more investing and stock market content. I'd love to know your comments down below with regards to your thoughts on ETFs and if you invest in ETFs as well. And with that guys, I hope you have an awesome day. I'll see you next time. Cheers.